We have Niles Lichtenstein on the show here with me, and you could learn what he's up to by going to nestment.com. Again, it's nestment.com. And we're going to be talking about something that's going to be, frankly, Niles, I think you're going to be shaking up the world a little bit with this concept of co-buying real estate. It's a platform to help you accomplish that. Niles, thanks for joining me as we dive into this.
Well, thanks for having me. I'm really excited, and I will talk more about the different statistics as to why we do think there's a huge opportunity and to do something that's not necessarily new, because in a lot of cultures and groups, they've been doing this before, but it's one that structurally hasn't been supported. But we've seen that shift, and we've worked really hard to create that shift through technology, tools, and partnerships.
Well, can you talk a little bit about the inspiration behind this? What did you or your founder come up with this idea, and what were those first steps?
Yeah, so I think it's both. This is my third startup. First startup was in the mobile tech space. That was acquired, and that company went on NASDAQ. The second startup was actually a New York Times funded startup that's a sustainable SaaS company. And then this startup is one in which brings together both kind of a market opportunity, but also a passion. And I'll talk a little bit about its birth for folks, just to understand, because I think it is important where companies come from and why they're being built and what they're trying to solve for. So I actually started as early as 13. It was when my father passed. My mom was an immigrant to the country. We lived here in the Bay Area, and my mom didn't have a job at the time, and there wasn't as much savings, and we had two boys, and we were wondering what we were going to do. But fortunately, we had a home, right? And that home had appreciated. So at an early age, learned how to refinance and take some equity out of the home. And then we rented out, early days of Craigslist, we rented out rooms to UC Berkeley grad students, international students. So grew up with Swedish physicists and German architects and Nigerian math PhDs, which was fascinating. I didn't realize that growing up in a boarding house was a little unusual, and having to share bathrooms and occasionally stay in the living room was not the norm in a certain sense. But it provided us the stability of having the home that we didn't have to move from. And that always resonated with me, especially as we start to get into a place where more and more people feel like they're going to be lifelong renters and not have that. And I really, thank the fact that we had a home that to give us that extra capital when we really, really needed it. Went to Harvard for undergrad, and then came out of undergrad, did the big corporate route from investment banking to even advertising and management consulting, but ultimately ended up starting my first or being a part of a early startup in the mobile tech space that got acquired, and that company went on NASDAQ. And I had made a bit of capital at that point, and my cousins who lived in Oakland, were complaining and also making fun of me. That they said, you guys are the reason I can't afford to live in Oakland anymore, or San Francisco. So we decided, hey, what if we co-own, say a triplex in the area? We put down some capital, we kind of made it work and find different iterations. So, and I think one of the most amazing things is seeing, different properties like that go up over, and at that point, 2013, like 8 or 9 years, and seeing how the remarkable value of an equity appreciation, obviously a unique moment in time where low interest rates were low and appreciation was really high on properties, but that allowed folks to, after refinancing in early 2022, to have a sizable check. So that's a really meaningful, powerful kind of shift in thinking. Continue to co-buy different properties with family and friends. I live a Nestment life now here, where I live in the top floor. We have a building here in Nob Hill. We own it with another family, and we rent out units as well. And so we definitely, walk the talk. And then one of my co-founders, I joke that he started a company just so he could afford to buy. While he was working with me at our second company, he couldn't afford the Bay Area, couldn't afford San Diego, where he's from, to own. But he always loved going to Joshua Tree, and he really wanted to buy a place in Joshua Tree with friends and have it be an Airbnb or vacation rental, but also be able to visit. So that led to us literally just throwing out a landing page. And this is the advice I give to anybody with an idea. Just throw out a landing page, flight some Instagram ads, maybe do a LinkedIn campaign, see what happens, right? And we had all of these people, signing up for a product that at that point didn't exist, right? And people saying, hey, how did you know? Are you retargeting me? Like, no. Like, so we knew that there was something in the cultural zeitgeist. So we started to do hundreds of interviews of all of these people in early 2022. And then as 2022 was stretching on, interest rates were increasing and skyrocketing. And so people were literally saying, oh, I'm now looking at a property that cost me 2x what it was, just 6 months, 12 months prior. And so that notion of being able to pool capital, if there's supply is only going to be able to solve a certain amount, and it won't really come into effect, I think, in a big way and for the next at least 10 to 15 years. So you have to find demand side solutions. And we can talk more about, the different segments of groups that we focus on. We can talk a little bit about what are the areas of friction that we really are trying to take away. And I don't want to just keep on rambling. So we can go into all of those different areas, but let me know where you want to go next. But at its core,
this is all really great information.
Okay, great. Yeah, because at its core, what we're trying to really help with is Gen Z and millennials, helping them kind of hack the housing system to finally be owners. 84% are first-time home buyers, and 62% are actually, interestingly enough, professionals of color or come from immigrant backgrounds, which we found fascinating. Average transaction size is around 800,000. Average group size is closer to 2.5, actually, because most of the time it's between 2 and 4 people. It's amazing what happens when you split a check 2 ways or 3 ways, what that does, or 4 ways, what that does. And then there's really like 3 segments we focus on. One is what we call our shift audience. So second home is the first time buying. So that's our acronym, and we're kind of coining that term. And so we think of folks like Selena and Wade, 2 professionals in Brooklyn who are older millennials. They're like, we still don't own yet. We still can't quite afford a place in Brooklyn. So they're like, why don't we buy in Hudson Valley together first? Still live there part of the time, but also rent it out, offset expenses. And then we have folks like the Snapper Fin guys who are 23. They got their first bonus out of college, and we joked in February and March, it's bonus season. Don't buy a home, not a hangover. And they realized they could put their 3 bonuses together and buy their first long-term rental. So we have that group where they're taking the non-traditional path of what we've been told, like, hey, buy your primary first. But if you can't afford the primary where you live, how do you start? How do you not get frozen out of the market? The second major group is really the 2 to 4 unit market, where we have a lot of people, the kids on TikTok will call it house hacking, right? Where people are trading in their rent, purchasing a 2 to 4 unit building, being able to rent out a number of units, live in units, have a tax write-off, and leverage the depreciation while at the same time getting the leverage capital for equity appreciation. And, I think the biggest gift that was given for that particular segment was, obviously there's been FHA programs and stuff for a while, but Fannie came out with that new 2 to 4 unit ruling in November 18th of 2023 that allowed you to put 5% down, right? And use the rental income to increase the loan limits. And that is a huge opportunity. We're seeing, we have so many case studies now of people really leveraging that to their advantage to finally become homeowners. And then the last area is parent and children. So obviously adult children getting support from parents. How does that work? Is it going to be a gifting or co-ownership relationship? And then on the side, we're also experimenting with things like a pledged asset solution for baby boomers, maybe on a fixed income, who have a lot of equity at a low interest rate but don't want to sell their homes. Could they pledge that equity to help with the down payment of a child or adult child? So lots of really interesting areas. But again, shift, second home is the first time buying, primary multifamily, and then parent-child.
Okay. Well, there's a lot to unpack there. We're going to focus on the investment side of things, obviously, since you're on an investing podcast. But based on what you're saying there, let's talk about the investing aspect, whether it's the first time investment or somebody's trying to buy an investment property. Could you walk us through that second scenario that you were laying out there? I think that was the investment side of things, and how what would be somebody's experience going through this?
Yeah, so the 5 areas we try to take friction out of for everybody are group alignment. So we have tons of people who say, I've had this. We just did a workshop yesterday, and I can't tell you how many people said, I've been thinking about this for years, just didn't know where to go, right? Or I've been talking about this with friends over a bottle of wine, or, how do we? So the first step is group alignment. We give everyone a dashboard that has the roadmap of steps. As they're making progress through the dashboard, they're actually getting automated education. They have a co-buy coordinator, so a real human, not just chat GPT, but which we are building into the system. But that being said, you have a human walking through. So there's group alignment. The second thing, and happy to share my screen too, if that's helpful, and show the platform if that's here. Let me see if I can.
You sure can do that.
Why don't we go?
For those who are listening to the podcast, you'll want to run over to YouTube, look for REI Mastermind there to see what Niles is presenting.
Yeah.
But
So
I might take some screenshots and
yeah,
put
please
those
do.
in the show notes as well,
Awesome.
as
Yeah,
this is
so
released.
I'll share my screen here, and so what we'll go into, and feel free to read my text messages now. But each of our groups, so this is actually, I'll show you. We have lots of case studies online as well that we can share with folks. But these were 2 women, unmarried, but they shared goals to build generational wealth in LA, and there was obviously a lot of barriers. They met in a running club, and really, talked about it a lot, but now didn't know that they could just kind of pool their capital and come together, and ended up buying a home in a mile away from SoFi Stadium in Inglewood, living in one unit, but then it has a granny flat that they rent out and an ADU that they rent out and generate rental income from. So this is one example of some of the ways that people are actually accomplishing 2 things. We joke it's own to rent versus rent to own. But in the process, they have their dashboard where they've got their co-buying roadmap, everything from aligning their goals. And as they go through the process, they hit certain stages. We introduce them to their agents and lenders, depending on what their profile is and what they're looking for. It also helps them evaluate listings, so they can go in and pull everything from Redfin or Zillow, or they can search listings. We take, and this was one of the big things for me too, was if I used to have to use historical data when I was buying, right? And if you used historical data and let's say you looked at Austin, it might look good, but now we know Austin has all of that, pricing built, all of that appreciation built into the price right now. So the appreciation is a lot lower in a place like Austin, right? But we use kind of core logic data, 5-year forward-looking projections, and I can take you through some of our other rankings as well. But it allows you to play around, understand long-term rental, short-term rental. We leverage Mashvisor and AirDNA, integrate that. You can play around. In this case, they were able to use this program I just mentioned and put 8% down. We actually did a 2-to-1 buy down on the property. But just giving people the power for financial projections is really important. And I won't bore you with too much more, but there are other things up here that are helpful especially for investors. We do a ranking of long-term rental places, and now we update this every month, and now we're going to be adding short-term rental. But we basically do a lot of different things, from looking at leading indicators. So on places like, say, Realtor.com, they can rank by how fast, how many people are clicking on a particular area, or how fast something goes from sale to pending, to give a leading indicator. And then we leverage, core logic data to think about then more of a lagging indicator, where they're actually looking at, county taxes and net income increase and things like that. So we've created kind of a Nest score for different properties and places. So people can feel free to kind of look at this and say, hey, these are places. So we'll have a lot of people here where I'm in the Bay Area too, say like, look, I can't afford a place there, but I'm going to start with my first investment property and grow from there. And so we're giving them these 2 routes. One, go and buy a place that you can live and rent out part of it, or go and start looking at, these different locations. But all of this is free for folks, by the way. So, that's, I think, an important thing. So I'll stop sharing here, and I'm happy to share those links with you, Jack, later. But our main thing is, how do we, so it's group alignment, financial projections. Then we spent over $100,000 in a year and a half capturing as many of the best like co-ownership templates. helping figure out what the best systems are for that, like how to think about exiting the relationship, how to think about maintaining, what our best practices. So we have a agreement builder. Now we are not lawyers, so I should say that. So but what I found out when I did my first one and spent over $10,000 on it, I realized and looked at it and I was like, wait, this was just a decision tree. I could have probably just, figured this out. And so we want to pass those savings along. The fourth area is what we call, just lending and competitive lending. What was really helpful for us is we kind of officially launched in 2023, which was a really rough time for the real estate market, but it was actually a great time for us because lenders, large agents, and brokerages were all willing to sit at the table with us and start to think about how do you innovate together. And so we were able to work with lenders. When I would co-buy, people would ask us to put 30 to 40% down, right? But if we're thinking about why people are co-buying, it's because they need to pool the capital together, right? So we got our lenders to all of our kind of national lenders to say, 5 to 20%. So lower kind of, thinking about those LTV strategies. Also for qualified mortgages that we know are going to go into an LLC later, allowing that to happen after underwriting. So there's not the same do sale on clause or the issue that the gray area that some people get into, which is, to skirt, say, commercial rates, they might put it into an LLC later, but as long as they're servicing their loan, they're okay. But there's a kind of a gray area around that. We want to, try to avoid where we can, but make sure that we can give people a path to placing their property in an LLC if they would like to do that. So worked with our lenders on that. And then, there's all types of other lending that we've done over time. So we have a whole kind of slew of lenders and we try to figure out who fits the best. One of our best recent case studies was in Jersey City, which I'm a huge fan of right now. I call it the sixth borough, but it was two guys owned a cafe and they found out that their landlord was going to sell the building. And so they were able to pool capital and leverage Nestment to actually buy the building. Now they're their own landlord. They've got a short-term rental in the middle unit, which is doing incredibly well because when Manhattan shut down short-term rentals, people look for Jersey City, and then a long-term rental as well. So they're kind of diversifying their rental income in that way. But yeah, they were able to pool their capital with some other family and friends and go from being renters to actual landlords and their own landlord in the case of their cafe. So yeah, and the last one is agents. So I joke with agents a lot that, and I've been on agent podcasts where they said, yeah, when we hear that there's a group, we usually actually don't want to take them because for all the reasons you just mentioned, those groups fall apart, right? And so, and time is money for agents. So what we had to prove out all of last year was one, demand, right? So that there's enough people who are seeking this. And then if you look at the data, that new Intuit Credit Karma survey that came out that said 60% of Gen Z think that's how they're going to buy through co-ownership, 35% of all non-homeowners. It's a pretty massive, when you actually break those numbers down, it's pretty massive, but we had to prove it. And so what we did was we said, hey, we're going to give you buyers that are aligned, that are pre-approved, and you're the last mile because we appreciate your very local knowledge. So that's really what our focus has been with Nestment, is helping people through making sure it's a good analysis, finding the right lenders and buyers, and then we're launching next year our Nestment Hub, which helps them manage the expenses, the financialization, the group dynamics, and plugs them into property management groups as well. So
your platform doesn't help people find that partner, right? It's just it sounds like your platform helps them identify a property, helps them maybe get the financing in place, like banking, that type of things, pull in some basic information like taxes, insurance, a few other things. But you got to come with the partnership kind of already in place.
Correct. Yeah. So we've had the request around matchmaking and things of that nature. What I will say is there's so much latent demand of family and friends. And while people say, yes, I'd love to be match made, unless it's a larger syndicate where they're putting a less amount of money in, I think it's kind of a false positive, right? Right now, at least, right? Which is like, hey, yeah, I'd love the concept, but would I actually do it, right? Is another thing. So for the next couple years, it's really about all of this opportunity between family and friends, and how do you kind of create that? And then as it starts to normalize and become more mainstream, we definitely see a world where we will be helping people matchmake. And that's for investment properties, second homes, primary multifamily as well.
Just to remind everybody, it's nestment.com. You can find that as a clickable link in the show notes. And if you found some value in what we're talking about so far, do us a quick favor, share this episode with one of your real estate investing friends. And if you're watching us on YouTube, give us a quick like and subscribe. So, Neil, I have to ask this. I always say I said Neil, didn't I? I meant Niles.
Okay. Niles. In Europe, they say Niels. So.
Niles, I really want to know, when it comes to real estate investing and partnerships in general, I joke often that you either start off with an awkward conversation or you end with one. What do you do to help investors or co-ownerships initiate that initial agreement, put that paperwork in place so that everybody understands their responsibility, everybody understands their ownerships, and protect both sides?
Yeah, no, great question. Yeah, you always want to start with the alignment conversation, as we call it, earlier, right? You want to start with that at the beginning. So we give folks actually a set of discussion questions to talk about with each other, and then they can start to fill out the form too, which asks them, how is this going to be broken down? We have some recommended options, but we also have openness to customize, as well as a couple other options that people can take. And what we found, what was really interesting, was this was one of the biggest psychological barriers to co-buying at the beginning. But when people went through at that point, we had created a Google form for folks and realized what would be within the agreement, it made them feel better. So there's a whole first conversation that's really important. I think there's this line between privacy and openness, right? So usually there's openness about how much people can put down payment, how they're generally doing, things of that nature. Now, when we get into tax returns and things like that, the lenders will take the information separately, right? So that has some privacy, but then you'll see what your aggregate is valued at, right? And what you can afford and get approved for. And then there's a whole set of best practices. Like, we really encourage all of our groups to put 3 to 6 months of mortgage and expenses into either an escrow account or a joint account that doesn't get touched, right? And we do that because one of the biggest issues we'll see is that when emergencies happen, people freak out, right? And that's when things kind of can go wrong. So what we're trying to do is empower people with having the right conversations, having the right tools, having the right best practices, having a third party that takes on some of this responsibility, which is why we're building this kind of ongoing platform for folks as well. We're doing it manually right now, but it's a lot easier when Nestment is sending everyone the emails like, hey, this is what we have to do now, versus that one person who has to have that. And then the last thing is we brought on the advisory board like a family mediation expert, so someone who deals with money and family and friends, and so we've just been bringing them into to help guide some of the things that we're thinking about. But there's always going to be use cases, and we think a lot about that. But I think the incentive is so big, and if it's done right, there's a world of building community and building wealth that can be transformational for folks. So.
It sounded like you initially focused on talking about the smaller properties, whether it's single family homes. You mentioned ADU, a couple other things. Is there any other properties that can you do multifamily? How large of a property set can a person help?
Yeah, I mean, so we've definitely done more than the 5 units. I think our sweet spot has been the 2 to 4 units because they fall under residential, right? And so that's worked out really well. And then more like single family or multi-unit, I should say, and investment properties. You definitely have, we're working on the one that's an 8-unit right now for a group. Now, things will be a slightly different, right? You're going to be going the commercial lending side. You can start the LLC potentially beforehand, right? So there's a slightly different path, not altogether that different at the end of the day, but there's some slight adjustments that actually make it in some ways easier, but more expensive. We also are getting a lot more into how people can own the building, like, leveraging SBA and being able to own the buildings that their offices are in, or that they, or own the building that their business will be in at some point as well. So there's a lot of flexibility and a lot of learnings across the board. But generally, what we see, and the reason why we call it Nestment is even the people who are living and taking advantage of a primary multifamily or primary multi-unit, eventually everyone wants to get to their beautiful primary single family home, right? But that path takes a while for a lot of folks. And so how can you leverage other investment in real estate to get there? So yeah, I think, it's all part of the process. I think, again, why I'm a huge fan of the 2 to 4 unit and even more is just you're getting more costs, you're getting more square foot for the price. So it's a lower cost per square foot, but market rents tend to stay fairly similar in those units as well. So you can rent them out at market rates, but you were able to purchase it at a discount. So
when we've been starting things off saying co-ownership, there's usually maybe two parties involved. Do you have situations where there's more than that?
Yeah. So, up to on the residential side or the investment single family or 2 to 4 unit investment side, having up to 4 co-borrowers. It's funny, even loan officers sometimes don't even realize that you can have up to 4 co-borrowers on it. We are working on, there's different modeling for credit, right? So one of the things that irks me still is that sometimes they'll take the lowest credit score and apply it to everybody from a risk perspective. I think that's kind of wrong. And so I've been working actively with the GSEs. I know they're thinking about it too, about doing much more blended credit for co-borrowers. So if I'm going in with 2 cousins and 2 of us have great credit, 1 cousin has poor credit, probably we're bringing him along so he can build some wealth too in this situation. Mm-hmm. And we shouldn't be necessarily, shouldn't be pinged for that. But yeah, so we've had everything from a group of 2 to a group of 8, right? But the sweet spot becomes somewhere between 2 and 4 for most groups, because they own enough of it, right, that it makes it's a meaningful investment, and there's a certain sense of ownership over it. Like, you get into more than 4 folks, you start to really think about more of models like Arrived, maybe Picasso on the luxury end, but like Arrived, or I think Here.co was doing that as well on investment properties, where you're able to put in, which I love the notion of being able to put in $1,000, a couple $1,000s, but it's essentially kind of acting like a REIT in a way, but like, yeah. That's different than kind of true ownership. And also when we think about the tax benefits, right, of ownership, how can we think about that? So yeah, I would say, there's all types of group sizes, but if you can stick to that group of 4 or less, you're in a really sweet spot for lending.
Yeah, and when you're getting up and higher, I'd imagine that you're going to run into more and more regulatory compliance issues. Like, was there anything that you needed to be aware of or that surprised you when it comes to regulations regarding what you're doing?
So far, I think just because most of them have stayed below that kind of 4 co-borrowers, there's still gray areas in some of this areas. Like, so some of the transferring into an LLC, post underwriting, like things like that, where we want to make sure everyone's above board and talking about it. And so there's actively there, but there's still things that are trying to be worked out. I think the biggest thing is the operationalization of, when you're working with a larger syndicate of family and friends or people, right, is that someone has to act as the manager to a point that is, I think, probably you need a whole system for that, right? And so, it's whereas when you're at 2, 3, 4, the systems are a little more basic, right? In terms of decision making and things like that. So as you start to scale number of partners, I think you just have to have more systems in place. And then in models like the Arrive model, they were able to leverage the kind of Reg A on the SEC side and things like that to help them through that process.
Sure. You mentioned the tax benefits and a few other things. You also mentioned your hub. Is that part of being prepared and helping people with the transparency of the property, how it's performing, those tax benefits, that type of thing, so that they can be prepared for their tax preparer each year?
Yeah, exactly. So that's a huge part of it. In fact, when you interview people, because a lot of people have done this, is again nothing new. We're just taking a lot of the friction out of the process and making it easier so a much larger group can do it. But in a lot of interviews when we talk to people, one of the things that it always fell on one person, right? To get everything ready and they were late, and it was like, their K1s were late, and then that would cause issues and so forth. So part of the goal of the Nestment Hub is to do two things. One is actually three, really. One is to make sure that people understand their equity value, not necessarily their estimate, but we're pulling, say, the AVMs from a clear capital or things like that. What truly is my equity value? And then at what point could we actually project when you might be able to take some capital out, right? Like, if I was to ask you on X property, what month do you believe you can take capital out of that? Not many people know the answer to that question, but it's actually pretty simple calculus, right? If you have kind of a dashboard, you have time, you have forward-looking appreciation, you should have a general sense of when you might be. So there's this whole kind of like, hey, let me be able to look at my property, understand the P&L of it, understand the equity value, understand options for financialization. The second part is really around kind of I would say LLC management, as well as like accounting management, right? Like, what are the documents that you need? What are getting pinged and saying, okay, well, we're going to update. We need to get our statement of information in or something of that nature around this time, right? Really helping people through that. And then the third is actually what we're building out as a marketplace of services. So my wife happens to be an interior designer, and I realized I could take her 30% off restoration hardware that she gets as a trade account and give it to all of our customers at Nestment too, right? Like there's ways to do that as well, and take a percentage but then save our customers a percentage. So there's definitely a whole lot of really kind of interesting elements. I'd say the fourth, which is actually a whole nother phase, is while the operating agreements allow people to exit an off-ramp, we really want that to be easier, right? So we want it much easier to be able to do things like dynamic equity splits, right? The roof caves in, not everyone can afford. Rather than having to come up with money exchanging, you can start to actually change the equity of the property, right? Like you couldn't afford X amount. And I'm actually, we're invested as Nestment. We don't put a ton of properties on our balance sheet, but we invested in a few properties, a few groups that found great properties. We were being A, opportunistic, but B, we wanted to be one of those partners to learn as much. We had to kind of eat our own dog food, right? So there's a Hudson Valley property that's doing well, and they're making a pretty big decision to do some higher level renovations, which, we're a partner that didn't necessarily sign up for that. Like any of the small operational things, yes, but the larger things are on them. So now our equity is going to decrease in that property. Their equity increases because of the money they're putting in. That's just kind of, simple math, but just doing it and making sure people are clear on that. But yeah, being able to off ramp, either selling to the other owners privately to family and friends, or be able to actually even put it on a public exchange is something that we are looking at. And in terms of our future, it'll be my pipe dream, but eventually I'd love to see if the GSEs would allow us to have multiple mortgages on a single property, because that would create amazing liquidity for kind of co-ownership in a very real way. But I think we're a little far from that yet.
Yeah, I could see it eventually getting there, though. I mean, it's something they wouldn't be terribly new to if you can kind of convince them it's essentially doing a condo situation. I mean, it's multiple mortgages in a single building.
Yep.
So I'm going to change the subject just slightly on you in the last few minutes, because as a serial entrepreneur, I'd be interested in what type of advice you would give to other people who are considering entrepreneurship, or jumping into real estate investing or technology for that matter?
Yeah, I think the if I was to give one piece of advice, or there's one principle I love to live by, it's actually, and it applies to startups and real estate. It's patient urgency. And so with every one of my, whether I think about my property portfolio or I think about a startup, I write a 5-year narrative arc, right? Sometimes further, but for at least the next 5 years. So for Nestment, 2022 was about research and validation. 2023 was about establishing the platform. And I have metrics for each of these stages, right? 2024 was about building the movement. So get to 100 case studies that represent millions of users. 2025 is about scaling the movement, and 2026 is about structural change, right? But why I say patient urgency is because you have to act urgently. You can't wait. Like, we threw a landing page up, we tested the ideas, tried to get as much data. I'll always look for reasons to say no than yes, because I, know how I've got 2 little kids, there's a lot going on, right? But I think you have to have urgency to act, but then patience to let strategies play out. And this is why I also feel like, venture needs to take a look at itself, venture capital, in a way of like saying, what are we trying to accomplish, right? And how do we get to great outcomes? Because I'll tell you, in the prop tech and real estate space, real estate cycles are different than, say, a venture cycle, right? But if you bet and you can look at things long term, if you can work with also the powers that be in Washington, the GSCs, et cetera, you have that. So patient urgency is the way I like to approach both startups and real estate.
Well, this has been a very interesting conversation, Niles. I appreciate you giving us so much value. Again, I'm going to direct everybody to your website because there was a lot to unpack, and I'm sure there's a lot more to discover at nestment.com. Again, that's going to be a clickable link in the show notes, but it's nestment.com. And if you're ready, Niles, we'll jump into the rapid fire questions.
Let's do it.
But before we do, is there a question or concept you wished we would have covered so far here today?
No, I think we did a great job, and thank you for letting me speak gregariously.
Well, first off, what lie do real estate investors tell themselves and sometimes to others?
Yeah, that leveraged capital is always the equity solution. Obviously, in high interest rate environments, you really have to take a look at that and see how much you're leveraging. By and large, it tends to be true, but I would say look at the details.
Do you have a book recommendation, or what are you reading right now?
One that's kind of maybe a little out of left field is Setting the Table. It's the power of hospitality, and written by the guy who started Union Square Cafe and Shake Shack and so forth. But there's something about the nature of every business I've been in that had that notion of hospitality and experience has always kind of driven things. So I highly recommend that book.
If you could go back in time and give a younger self a piece of advice, what would you say?
I'd say find ways to get rid of cognitive load by dealing with things within 24 hours if you can. And what I mean by that is, I think generally we spend way too much time and energy, tampering down. Maybe this is just me, but I feel like I see it tampering down the voices, whether it's of doubt or of other things, or someone slighted us or someone did something wrong, and without just addressing it. So at our company, if there's something that goes on, we actually have levels of problems and how you address them, but you always address it within 24 hours. It lowers the emotional impact and resonance of it, but it also frees up your mind to focus on abundance and joy and not fear and scarcity.
That's an interesting one. What single strategy, process, or tool have you implemented that has had the biggest time-saving impact to your business?
It's funny. It's actually the same thing, but we did implement five core kind of principles or values, and then we uphold those every Monday. We do a 30-minute alignment, and every Thursday we do a 30-minute retrospective. And we're not a heavy meeting group, right? And so, but that 30-minute alignment and that 30-minute retrospective has been really, really meaningful for me. And then I've implemented for myself, Mondays, there's no big presentations or anything of that nature, because then I can enjoy my Sunday or focus on strategy, which makes me a lot clearer. Tuesday through Thursday, I'm focused, work really, really hard. Friday is more of my social and partnerships days. And so by creating, as someone said, it's not about time management, it's about boundary management. So.
Well, again, Niles, this has been a fantastic conversation. I'm going to send everybody to nestment.com. Again, that's a clickable link in the show notes, but really appreciate your time. It was great meeting you, and I hope you'll come back again sometime.
Thank you, Jack. I appreciate you highlighting what we're doing, and thank you for all the work that you're doing in this space and helping people invest in really interesting ways.